Okay, so welcome to this section. It's called cash flow forecasting, and today we'll be going through the cash flow prediction model, which is module 5 in my profitable business blueprint. Now, when we say cash flow, yeah, it actually means that money is actually flowing. Money is flowing in and money is flowing out. Yeah. Cash, the word cash flow, as I said, is not same as a cash statement. A cash statement is how much money you have right now. Cash flow is money coming in and money going out. And that money can be positive or negative. And we'll be going through all of that. And a forecast means that you're predicting the money for the future. This is really, really, really important. Okay, let's get into it. So, what exactly is the cash flow projection? The cash flow projection, as I said, is an estimation of how much money is expected to flow in and how much to flow out of your business at a specific time. Yeah, obviously it covers income, expenses, also capital expenditure, also any cash flow from financing, like loans, etc. Also, if you sell any assets, etc. There are three main types of cash flow. You might want to write this down. Yeah, there are three main types of cash flow. Basically, what we got cash flow from operations. We call it OCF, operating cash flow. We got cash flow from investing, ICF, and we got cash flow from funding, we call FCF. Okay, but a cash flow prediction looks at the future, and it can be done weekly, monthly, semi-annual, as it's or even annual. I just actually been talking to a client, a big client of mine, and they're getting problems to understand that cash flow means exactly how much money is sitting in your bank account at a particular point. It's not a budget, is actually predicting how much money is going to be coming in and going out of your bank at a particular point in time. Okay, so there are different elements, as I said earlier. We've got a cash inflow, and that's the money actually coming in from sales or even from debtors. What are debtors? Debtors are when you make a sale and the person pays you late, or you agree to them that they're going to pay you 7 days later or 30 days later. Any interest received, or unless you have an investment or you have money in the bank, that's a cash inflow. Yeah, rent payments. For example, I invest in properties, and if someone pays me rent, that's actually an income. It's an investing cash flow, and that's actually a rent received, and therefore is cash inflow. Bank loans or asset disposal, these are all cash inflows. Okay, cash outflows occurs when you move money out, as it says, outflow. Now, if the inflow is more than the outflow, that's called a positive cash flow. If the outflow is greater than the inflow, is called a negative cash flow. And the net cash flow is the difference between the two. As I said earlier, it can be positive or it can be negative. So I'm sure that you would agree with me that it's good to have a positive cash flow in business. But if you have a negative cash flow, you will need to have something like an overdraft facility. It means that you're not using your money anymore, you are now using the bank's money. Okay, so why is it important to predict your cash flow? Well, as your business owner, like many of you who are listening to this live, and people who might be listening to this on my online training programs, etc., effectively, you want to predict your cash flow because you want to know how much money you're going to have in the bank in a month time, or how much money you're going to have in the bank in 3 months' time, or even in a year's time. Because the reason why you're in business is to make profits, but ultimately to make money. And profit is not cash. Profit is a calculation of income minus expenses. But with accounting, you account for the income whether or not you had the money. So cash flow forecast is when you predict exactly how much money you're gonna have coming in and how much money you're gonna have going out at a particular date and over a period of time. This is an example of a cash flow prediction statement or a cash flow statement. You got an opening balance for January. You got some sales. In this case, it's a cash sale. Yeah, because there's no collections here. You got materials, you got marketing. This is physical money. So you can predict this back in December. So you can predict this even for next year, January, February, March, April, etc. But you must understand your business. And then what you're gonna have is a closing balance. So you know exactly, do you have enough money to say invest or pay yourself a dividend or buy something that you did not even plan for. Now, in this case, in these months of March and April, we got a negative cash flow. What do you mean by negative cash flow? It means that more money had gone out than had come in. And I will ask you guys a question or two if required, but I hope you guys are understanding this principle. This is a positive cash flow, means that more money has come in than gone out. This is a negative cash flow, means that more money has gone out than come in. How do you do a cash flow projection? And there'll be an exercise, so pay attention. You want to understand how much money you have at the beginning, right now. So you can do a cash flow even for yourself, even for your personal money. You can say, well, how much money do I have right now? Okay, estimate how much money you're going to have coming in over the next 3 months. You can estimate that, literally. If you got an income, that's easy. You got a business, it's more difficult, but you can still predict it because it's an estimate, right? You can estimate the expenses for the next 3 months. It's called a quarter. Then you can subtract the two, and that will effectively give you your net cash flow. It's a very simple statement. But if you take the opening minus the income, sorry, you take the opening, excuse me, plus the income minus the expenses, you will get your closing cash balance. Okay? Yeah, that will give you your closing cash balance. All right. So when you're predicting your cash flow, it's very important to understand the timing of the cash flows that go into the business. Yeah, the size and the timings, etc. And you need to understand, you need to understand your business at end decree. Okay, and that's why I've come up with a cash flow prediction model, which I will be talking to you about shortly. And I said profit is not cash because cash is physical money. Okay, and profit, you can actually have a profit and still run out of money. Happens to a lot of big businesses because some businesses, they spend a lot of money on what is called like capital expenditure, etc. Yeah. So a positive cash flow does not always mean a profit. You can have a lot of money coming in, but you can still make a loss. You can still make a loss even if you have money in the bank. It just means that the timing of expenses, effectively, if you buy goods on credit, you buy the goods on credit, and therefore you haven't paid for it yet. And okay, let's say you sold the goods but you haven't made a profit, right? You just managed to sell all the goods. Okay, let's even say that you made a small profit on it, and then you go and buy more goods, but you have not even paid for the first goods anyway. Well, when you start to pay now your creditors, you can run out of money. So cash does not always mean profit, and profit does not always means cash. And I know that you're gonna have some questions on that, and you can ask me that coming up. I just see that using is spelled wrong. This could result from selling outputs of very long credit. Yeah, one of the main reasons I've seen people who have inventory, people who have stock, like yourself, Sharon, who is doing eBay business. One of the big things I see with people is that they buy stock and then they don't sell it in time to go and buy or buy any new more stock, right? And effectively, what I have is that they have so much stock on hand, but they just don't have they don't have a good cash flow because the money is not flowing. You see, because in business you want your money to flow. When you put money out to do something, you want to get the money back in with a profit. Yeah, that's really important. So this the cash and the profit. Profit is not cash. According to the UK Department of Trade and Industry, many business failure a lack of cash flow. This is really true, especially in new businesses. I want you to pay particular attention that too little cash flow can cause all these problems. Uh, you can lose credibility with suppliers. You can end up having to pay interest charges, high interest charges. Yeah. You're unable to pay your taxes. You're unable to pay salaries. That will result in people demotivated. So there are many, many problems of having poor cash flow. Many, many problems. Okay. And as I said, profit, we know, is income minus expenses, and this happens whether or not you've had the money or not. And that's why it's important to time when the money is going to come in and time when the money is going to go out, so you can predict your cash flow. Okay. And so one of the main reasons why profit is not cash, etc., is because of the timing. The timing. Okay. The timing of payments. That's really, really important. Now, in business, you want to have liquidity. And one of the ratios on the balance sheet that many banks look at is liquidity. Do you have more cash or current assets than you have current liabilities? I'll pause in a bit and see if you have any questions. But liquidity management is really important. Liquidity management means that you have enough cash to manage your business. You have enough cash to manage your business. Okay. Of course, if you don't have enough cash to manage your business, you can use credit. And credit is good if you, or even having business credit cards. I actually recommend that if you can, use a business credit card if you can. Yeah. If you can, use a business credit card. Serious. A business credit card helps you a lot. Okay. So that's really important. All right. Unexpected bills again. Sometimes again, you can have unexpected circumstances, unexpected bills that you didn't even plan for, and therefore you can actually run out of money.